It's midnight. Your Figma still glows, Stripe test payments are flowing, and your co-founder just sent a Slack that reads, Sole Prop, LLC, Corporation, we launch in 30 days. Pick one. Your stomach drops. You were ready for design choices. You weren't ready for cross-border tax philosophy. Start with the only question that matters. What is the next 18 months of your company actually going to look like? If you're testing a solo SaaS with no employees, no investors, and you'll ship from one country to a handful of customers, a sole proprietorship can be perfect. It's cheap, it files with your personal return, and you can close it with a sigh instead of a lawyer. The pain points show up the moment you add real risk or real scale. You have no liability shield beyond whatever insurance you bought. Profits are taxed to you immediately, even if you keep cash in the business. And the day a corporate client asks for a W-9, VAT number, or a certificate of incorporation, you start apologizing. Sole prop is a bicycle. It's brilliant until you try to carry a sofa. An LLC feels like the adult bicycle with a child seat and a basket. You get limited liability for most mistakes that aren't fraud. You can elect how it's taxed in many jurisdictions. In the US, a single-member LLC is usually disregarded for income tax by default, so profits pass straight to you while still giving you a legal wrapper for contracts, bank accounts, and IP ownership. Add a second member, and you're a partnership by default. Flexible allocations, pass-through tax, and the ability to move money around without formal dividends. For bootstrappers or service businesses with modest margins and no venture investors, this flexibility is oxygen. You avoid classical corporate double taxation. You keep governance simple. And your accountant can tailor allocations when co-founders have different capital contributions. The cracks appear when you chase scale or outside capital. Venture funds often can't or won't invest in pass-through entities because their own investors don't want partnership tax K-1s, or because certain tax-exempt and foreign LPs get unwanted, effectively connected U.S. income. If that's your world, a corporation is the default. And even if you aren't raising, there are times the corporate box simply fits better. You may want to retain profits at a lower corporate rate to fund growth. You may want a clear cap table, formal share classes, options, and investor protections. You may want eligibility for special exits, like the U.S. qualified small business stock regime that can exclude large gains on sale if you play by the rules. Corporations are also what many global clients expect when procurement calls. In short, if you plan to raise venture, issue stock options at scale, or sell globally with enterprise buyers, don't overthink it. Incorporate. Now we tilt the camera from entity type to which country cares. Tax doesn't ask what your logo says. It asks three boring questions. Where are you resident? Where do you create a taxable footprint, a permanent establishment? And where do your customers trigger indirect tax like VAT or sales tax? Residency is the country that claims your company as its home base, usually where it's incorporated or truly managed and controlled. Permanent establishment is the second layer. If you have an office, dependent agents who close deals, or long projects that look like a fixed place of business, another country can tax your profits there, even if you didn't incorporate locally. VAT/GST is the third rhythm section. The second you sell digital services or goods into a region past its threshold, you register, charge, and remit, regardless of your profits. Let's run a few movies so this bites. You're a designer in Lisbon, launching a solo course platform. You sell to EU consumers. Sole prop plus Portuguese VAT number gets you to market in a day. You register for the EU one-stop shop to collect destination VAT and file one quarterly return. Your risk is low, your admin tiny, and you can upgrade later without drama. That's a yes. Another movie. Two co-founders in Austin building dev tools aiming for pre-seed and a Delaware C-Corp. The C-Corp is inevitable. Investors expect it. Option plans are cleaner. You may qualify for QSBS if you meet the rules and hold 5 years. Keep IP in the company from day one. Run payroll correctly. If one co-founder codes from Canada for months, watch permanent establishment and payroll rules there. Or you'll end up with a Canadian tax problem inside a US dream. Third movie, a profitable agency with a remote team scattered across Spain, Poland, and the Philippines. You formed a US LLC years ago and love the pass-through simplicity. Now clients are bigger, team members sign SOWs, and someone opened a co-working hub in Madrid with your logo on the door. That hub, plus a manager who can conclude contracts, is the textbook definition of a permanent establishment in Spain. You can keep the US LLC, but Spain can tax the profits attributable to Spanish activity. The fix is governance and structure. Don't let dependent agents conclude deals locally. Push contract signature back to the head office. Or accept PE and register properly with corporate tax and Social Security in Spain. Pretending it's not there is how audits happen. Here's where the entity choice marries international reality. Pass-through entities are tax efficient for owners in the same country as the company because profits flow once. Cross-border. Pass-throughs can create mismatches. Your home country might tax the profits you never actually received, while the operating country also taxes them at the entity level because it treats your LLC as opaque. Corporations can be simpler in cross-border settings because other countries see them as taxable persons. You may accept some double-layer friction in exchange for clarity and treaty protection. Add the personal-level rules, like controlled foreign corporation regimes and anti-deferral rules, and the picture sharpens. If you live in a high-tax country, parking profits in a low-tax company abroad may simply trigger CFC pickup to you personally. No palm tree beats a CFC statute. Where should I incorporate is usually code for which country's story will my investors, banks, and tax treaties respect. If you're US-centric with venture ambitions, Delaware C-Corp is muscle memory. The courts, the cap table mechanics, and investor familiarity are worth the filing fee. If you're EU-based and targeting European investors, local incorporation where you truly operate is cleaner, paired with the EU's participation exemption regimes that can reduce tax on dividends and gains for qualifying shareholdings. If you're bootstrapping internationally and don't need venture mechanics, the best country is often the one you actually live and work in, because management and control rules will treat you as resident there anyway. Incorporating in a distant low-tax island while you run everything from Berlin is how you collect acronyms: CFC, PE, and penalty letter. Liability is the unglamorous hero that should influence your pick. Sole props expose you personally. One nasty indemnity clause, one slip and fall at your pop-up, one IP dispute, and your savings join the party. LLCs and corporations create a moat. It's not magic. You still need proper contracts, separate bank accounts, reasonable salaries, and board minutes where a board exists. But the shield is real. If you're shipping code that runs payrolls, hosting medical data, or storing payments, corporate shield plus insurance is mandatory grown-up behavior. Compensation and Social Security are the other quiet forces. Pass-through owners often pay self-employment or social taxes on their shares of profit. Corporate owners can pay themselves a salary and potentially reduce certain payroll burdens depending on the jurisdiction. But you can't starve yourself to dodge payroll. Tax offices know reasonable compensation when they see it. Cross-border, Social Security runs on its own rails. You need certificates of coverage if you're seconded temporarily, and you need local registrations if your people really work there. You can choose entity boxes all day. If your payroll is wrong, your risk lives elsewhere. Funding plans are the obvious fork. Angels and VCs want shares, options, vesting schedules, drag-along and tag-along rights, preferred classes, and pro rata. These live naturally in corporations. LLCs can mimic many of these features with unit classes and profits interests, but the moment a fund says we can't hold pass-through interests, the theory ends. If you'll stay customer-funded and share profits with a tiny team, LLCs and partnerships can be elegant and tax-efficient. If your exit story needs standard venture machinery, incorporate and don't look back. Intellectual property location is the plot twist too many founders ignore. Where is the IP created, owned, and controlled? That answer drives transfer pricing and future tax on royalties or gains. If your dev team lives in France but your company is in Estonia, you still need to pay the French people and respect French rules, and you may need intercompany agreements that reflect where the value is built. If you plan to sell the company, clean IP ownership in the operating entity raises valuation. Nothing spooks buyers like, our code is owned by a contractor's cousin in a different time zone. Indirect taxes, VAT, GST, sales tax, don't care about your cap table. They care about what you sell and where your customers live. Digital services into the EU trigger destination VAT with low thresholds. You can often use the one-stop shop to file one return instead of 27. The UK has its own rules post-Brexit. US states enforce economic nexus for sales tax after Wayfair. Hit a revenue or transaction threshold, and you register. None of this changes your LLC versus corporation choice, but it changes your timeline, your pricing, and your monthly chores. The adult move is to register early where required, bake tax into prices for consumers, and file on a cadence that won't surprise you. Let's get practical and choose. If you are solo, pre-revenue, and validating a product in your home country with low liability, start as a sole proprietor for speed. Get a separate bank account, a lightweight bookkeeping tool, and insurance. The minute you sign real contracts, accept liability or see stability, roll into an LLC or local limited company through a tax-free conversion route if your jurisdiction offers one. If you are 2 or 3 co-founders without a near-term venture raise, an LLC or local limited company taxed transparently keeps life simple. Draft a real operating agreement that covers vesting, IP assignment, buy-sell mechanics, And what happens if someone disappears? Pay yourselves reasonably. Don't funnel personal groceries through the company. If you are raising venture or want equity compensation at scale, incorporate as a corporation in the jurisdiction your investors expect and where you actually run the business. Issue stock with vesting, adopt an option plan, and keep your board minutes like a grown-up. If you're truly international from day one, with a founding team split across borders and customers in multiple regions, pick one nerve center country to be the parent. Incorporate there and create local subsidiaries or contractor relationships with clear contracts. Accept that you'll register for VAT/GST where you sell and for payroll where you employ. Don't chase flags, chase coherence. There are also honest tax carrots you can intentionally design around. R&D credits in many countries can reduce corporate tax or even generate cash refunds for young companies doing real development. Patent box regimes reward qualifying IP income in certain places if you follow substance rules. The US QSBS regime can turn a future share sale into a mostly tax-free event if you meet the active business tests, hold 5 years, and avoid service business traps. Several EU jurisdictions offer participation exemptions on dividends and gains when a parent sells a subsidiary. None of these are gray schemes. They're the rules, written to be used. If they match your business, use them early so the paperwork lines up when it matters. What about incorporate in X because taxes are zero? That pitch always ignores two things: where you live and where you work. If you live in a high-tax country, it likely has CFC rules that pull low-taxed company profits up to you personally each year. If you work from that country, its management and control test can deem your fancy offshore company resident at home anyway. If your team sells locally, you create permanent establishments that owe corporate tax there regardless of where the parent sits. And your customers, platforms, and banks prefer boring compliance to exotic mailing addresses. If your plan only works if a judge agrees that blue is red, it isn't a plan. There's a soft human checklist to run before you sign any form. Write a one-page memo to your future self answering 5 questions in plain language. Who are the owners and where do they live for tax? Are we raising external money in the next 12 months? Where does the company truly make decisions and write code? Where do our first 50 customers live? And will we cross VAT or sales tax thresholds there? Do we need a liability shield before we send the first invoice? If you can answer those 5 without squinting, the entity choice pops off the page. Then execute like a professional. File the formation, get a tax ID, open a business bank account, sign IP assignment agreements that move code and designs into the company, register for payroll where you actually employ, register for VAT/GST where you actually sell, and put board or member minutes in a folder that someone other than you could understand. Keep contracts signed by the right entity. Don't let dependent agents in other countries conclude contracts if you're trying to avoid a local permanent establishment. Pay attention to Social Security coverage certificates if you second yourself abroad. And for the love of all that is caffeinated, don't co-mingle personal and company money. If you outgrow the box, you can migrate. LLCs can elect corporate treatment in some systems or convert into corporations. Corporations can create holding companies and push operating assets down. Sole props can contribute assets into new entities, sometimes tax-free under local rules. These aren't first-date decisions. They're operations you schedule in a calm month with counsel who has done it before. The mistake is staying in the wrong box out of inertia. Close the laptop. Write your one-page memo. Pick the box that matches your next 18 months, not your fantasy IPO poster. Register where you really operate. Collect the taxes you're supposed to collect. And keep the receipts like a librarian. Do that, and your company gets what it desperately needs in its first year: momentum without mess.